Hi, I'm Dennis Rodkin. I write the Deal Estate column for Chicago Magazine, and this is DEQs, where I answer your real estate questions. Beth in Streeterville asks, how will I know when the real estate market in my town or neighborhood has hit bottom? What are the signs to look for? We mostly recognize the bottom after the fact, Beth. We mostly know, looking back, that things have turned up. And it's also hard to be sure on a tightly local basis because our region rises and falls as a region on things like job growth or shrinkage, as well as rising or falling on individual data points in individual neighborhoods and towns. However, that all said, there are some basic signs that you can look at for an individual locality. One would be that there are fewer foreclosed or otherwise vacant properties sitting on the market waiting to sell. Homes that are on the market, whether vacant or not, are selling faster. And prices have started to tick up, however slowly that happens. If the number of foreclosures is dropping in your town, that is a very good sign. An even better sign this spring, according to Jim Kinney at Baird & Warner, is to watch. There's going to be, almost anybody will tell you, there's going to be a flood of new foreclosures coming on the market in 2012. So if your town has not, at the end of this spring, added a large number of new foreclosures, then that's a sign that you have weathered it pretty well and may be on your way back up. Kinney says that one quick eyeball test in your location is to look around at properties that have stood vacant for a long time. Many of them seem to have permanent for sale signs in front. If you're seeing less of that, then it's another sign that things may be moving faster in your neighborhood. Of course, there's another way to find out how fast they're moving, and that is to consult with a real estate agent. Find out if market time is improving. You'd like them to be on the market for less time. And also if prices are stable or rising. Of course, we'd love to see prices going up, but just being stable, not dropping, is also a sign that the bottom may be passed. It's very important to keep in mind that we're not talking about a one-time uptick. We're talking about a series of months or a long period in which prices have not gone down or have gone up. The Tribune reported in late January about 12 zip codes around the Chicago area where things looked really healthy in late 2011. And the Tribune was very careful to point out this could be a moment in time. It's important to pay attention to performance over the course of several months to be sure that it's not, for instance, one rogue sale. Kinney talked about how sometimes somebody comes into a market, doesn't care about price, imagine that, and just buys at a higher price, and that jacks up the statistics. There's also an effect I've noted doing our charts every year, especially in lakefront neighborhoods. A very expensive mansion on Lake Michigan has the power, when it sells, to jack up the average in town unrealistically. So you've got to make sure that it's sustained performance. And then the last thing to look at is a rent-to-buy calculator. As we know, a lot of people have been renting recently. You can look online to find a calculator, and the essential thing you're trying to find out is, are prices for sale less than 15 times the annual cost of renting a home? If they are less than 15 times that, then the pendulum has swung back to a for sale market. That works, of course, only if you're in an area that has a lot of rentals. Thanks for your questions. Send me more at dennis@rodkin.com.